this is Andrew Darlington with Veritas Risk Management Insurance Services, where we give you the truth about insurance. I have some business owners that a lot of times will ask me about some type of buy-sell agreement. They really don't know what it is. They know they've heard about it. They probably need to have something done. But I want to kind of give you a little bit of information how that works and why you would want to have it. Buy-sell agreements or life insurance for business continuation is kind of what you hear around. Basically, a buy-sell agreement, that's an agreement that you have with other shareholders or a partner in the business or that type of person, that you make an agreement to buy the business upon a certain period of time, whether it could be a time of years, it could be, I'm going to work 10 more years, then you're going to guarantee to buy the business, or upon my death, you're going to buy the business. Generally, the way that works is most spouses don't want to be partners with the other partner. The partner doesn't want to be partners with a spouse. The spouse would much rather have the money. The partner the partner that's alive would much rather have the business. So that's the way they want to have it done. And that's where this comes in. In this scenario, what we have is we have business owner number one, business owner number two, and the business. In this situation, it could be either a corporation where there's shares of stock, an LLC where there's a percentage of ownership, or just a plain old partnership. But you have two owners in a business. We're going to assume in this situation each of them owns half the business. The way it would work is owner one has a life insurance policy on owner two, and owner one is the beneficiary of that policy. The reverse is true. Owner two has a life insurance policy on owner one, and owner two is the beneficiary. A very, very key point. You must pay this with after-tax dollars. So the business would pay the owner, if the premium's $1,000 a year, would pay the business owner $1,000 a year extra in salary. So there's going to be some tax consequences there that you're going to have to pay. But then the owner would actually write a check out of his own checking account for this life policy. That's the way this would work. By doing it that way, the proceeds are tax-free. And you don't want to have a situation where you're getting the money with after-tax dollars, and even what you can write off is not a good deal. So never write that off. It's just an expense, just like your personal auto insurance or your personal homeowner's insurance. It's just an expense that you're going to have. So the way that it would work is owner one passes away, so owner two receives life insurance money from the life insurance company. He's going to pay owner one's family for the ownership. So if it's a $500,000 policy, we're saying the business is worth $500,000, each owns half. So he's going to give $500,000 to the owner's family. They get $500,000 cash for the business. Now there's going to be some tax consequences that they're going to have to pay because they're selling a business. So it may be short-term capital gains, long-term capital gains. You need to talk to a CPA about that. But owner two is getting the whole $500,000 with no taxes, tax-free. What happens is they're paying for the business. The ownership now comes to owner two. So now owner two owns 100% of the business, and he actually has a stepped up value because he's paid an additional $500,000 for the business. So if he sells the business for $500,000, he pays zero taxes. So he gets what they call a step up basis of the business, which is a really neat thing. So that's the way that would work. The reverse would be true as well. So it's pretty easy when you have two owners, it's done that way. If you have three owners, it's a little bit different. In this situation, we're going to consider it to be a corporation with actual shares of stock. In this business, when they formed the business, there was 2,000 shares of stock, but there's only three owners. Each of them owns a third of the business, and the business has the other share of stock. So in this situation, each of them actually owns a third. That's the amount of stock that they have, and then there's a treasury stock there for the business that they own at the time. The way it would work is each owner would have a life insurance policy on them. The business would pay it, not tax deductible. It's an expense. It's not a deductible expense though. But the business would own it. They would actually pay the premium for that. Okay, so it's going to work a little bit different because you have so many. You can have 8 different policies going if you wanted to in a situation with 3 owners, back and forth between the owners. But a lot of times it gets very confusing. So just having one policy this way makes it work a little bit easier. What happens is owner 3 passes away. So the business gets the $500,000 is what we want to say the business is worth, say $1.5 million. $500,000 is what the business gets tax-free because they pay the money with after-tax dollars. Business is going to pay owner 3's family the $500,000. They are going to have to pay tax on that, again, short-term, long-term capital gains tax. They're going to have to pay on that. And then owner 3 is selling the stock back to the business. Okay, so that's going to leave only 2 owners left. So then what it would look like is owner 1 would still have 500 shares of stock. Owner 2 would still have 500 shares of stock. The business would now have 1,000 shares of treasury stock. So each one now owns 50% of the business. The business is there, and now the other party's out of the business, so there's no spouse or kids or anybody that's part of the business that they have to worry about funneling money out to. So that's the way it a lot of time will work in those situations. Either way you do it is going to depend on your specific needs. Sometimes they want it done one way, sometimes they want it done another. In this situation, these 2 owners do not get a step-up value of the business because they only get the step-up value of what they put in. And they didn't put in any additional money in there. The business actually paid it. So that's a drawback for that one in certain situations. Here's the key points. With any buy-sell agreement, you always pay the premium with after-tax dollars. Do not write it off. Whether the business is paying it or the individual owner is paying it, do not write off that as a business expense. Do not write off taxes. Pay it with after-tax dollars. That way, you receive the proceeds tax-free, which is huge. You don't want to pay tax on $500,000. It's just not a fun thing to do. And then the other thing is that you possibly receive a step-up value. When the 2 owners have policies on themselves and then they buy the business from the other owner, you are going to get the step-up value of the benefit. If you have the corporation do it, you're not going to get the step-up value for the owners in that situation. Again, if there's any questions you have along those, or that's something you need to set up, call us. Our number is 292-4142. We'd be happy to help you. You can check us out on the web at veritasrm.com. And remember, we give you the truth about insurance.